Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Understanding the PEG ratio, an investor's guide to smarter stock valuation. Ever wondered if there's more to stock valuation than just the P/E ratio? Meet the PEG ratio, a powerful tool for investors aiming to get a clearer picture of a stock's worth. Unlike the basic P/E ratio, which only considers price against earnings, the PEG ratio adds growth into the mix. This simple yet effective adjustment helps investors see if a stock is overpriced or a hidden gem. By factoring in the expected growth rate, the PEG ratio provides a more balanced view, helping you make smarter investment choices. Dive in to see how this metric can transform your investment strategy. Defining PEG ratio. In the investment world, metrics like the PEG ratio are like tools in a toolkit, each serving a distinct purpose. Understanding its nuances can vastly improve your stock assessment game. Let's explore what makes the PEG ratio a favorite among savvy investors. What is the PEG ratio? The PEG ratio, or price-earnings to growth ratio, is a vital measure in evaluating whether a stock is suitably priced, considering its expected earnings growth. While the traditional P/E ratio just looks at price relative to earnings, the PEG ratio digs deeper by including the growth aspect. This makes it a more holistic tool. Imagine buying a car. You wouldn't just look at the price. You'd want to know about mileage, performance, and future value. Similarly, the PEG ratio offers a comprehensive view of a stock by integrating its future earnings potential, helping you determine if you're getting a fair deal. Formula for PEG ratio. Here's the formula that brings it all together. PEG equals price, earnings, growth rate. By dividing the P/E ratio by the expected growth rate, the PEG ratio contextualizes the price you're paying for each unit of earnings in terms of future growth. A PEG ratio of 1 is often considered indicative of a fairly valued stock where the price matches the growth expectations. Components of PEG ratio. To fully grasp the PEG ratio, let's break down its parts. Price. This is what you're ready to pay for a share of the company. It's more than just a number on the ticker. Price reflects market perception and sentiment. A stock's price can tell tales of investor confidence and potential. Earnings. Think of earnings as the company's report card. It shows how much profit the company brings in. Earnings provide insight into a company's profitability and efficiency, serving as a foundation for analyzing value. Growth rate. This is the anticipated rate at which the company's earnings are expected to increase. The growth rate is pivotal, offering a glimpse into the future, projecting where the company might be headed. It's about anticipating tomorrow's leaders today. Each of these elements plays a crucial role in the PEG ratio's calculation, and understanding how they interact can empower you to make more informed investment decisions. Importance of PEG ratio in investment. While the P/E ratio has long been the darling of stock enthusiasts, the PEG ratio steps up the game by adding a layer of depth with the growth perspective. If investing were a game of chess, the PEG ratio would be your strategic play, considering not just the board's current state but your opponent's potential moves. By weaving in growth expectations, this metric offers a clearer, more forward-looking approach to stock valuation. Comparing PEG to P/E ratio. When you look at just the P/E ratio, you're only seeing today's picture. It's like judging a book purely by its cover. The PEG ratio, however, nudges you to peek inside, considering how the story may unfold. Why is this important? Beyond static numbers, P/E offers a snapshot of current price to earnings, but PEG includes growth, making it dynamic. Holistic valuation. With PEG, you don't just ask, is this stock cheap? You ask, is this stock's price fair given its growth potential? Imagine buying a plant. P/E measures what you pay for its current height, while PEG evaluates how tall it might grow. Wouldn't you want to know if that sapling could turn into a towering oak? Evaluating growth stocks. When it comes to growth stocks, the PEG ratio is like having night vision goggles while others wander in the dark. It helps illuminate the potential of stocks poised for earnings expansion. How does it do that? Revealing future leaders. Growth stocks often trade at high P/E ratios, making them seem expensive. PEG balances the scale by factoring in anticipated growth, providing clarity on whether the price is justified. Contrast with value stocks. Value stocks might have lower growth rates. By comparing PEGs, investors can discern which offers more bang for their buck relative to growth. It's like choosing between a fast sports car and a reliable sedan. The sports car, growth stock, looks flashy and costs more, but the PEG ratio assesses if its speed, earnings growth, justifies the price. Conversely, the sedan, value stock, mightn't have the same rapid acceleration but could offer steady returns over time. For investors, the PEG ratio is not just a number, it's a lens to view the stock market's future landscape with more precision. Calculating PEG ratio. To properly assess a stock's value with a forward-looking angle, the PEG ratio steps in as a handy tool. Grasping its calculation is not just a task but a skill every serious investor should hone. This section will walk you through calculating PEG ratio with practical examples and guide you on finding necessary data in financial reports. Step-by-step calculation. Calculating the PEG ratio may sound complex, but breaking it down into steps simplifies the process. Let's tackle it with some hypothetical figures. Determine the price-earnings P/E ratio. Assume a stock price of $50 and an earnings per share EPS of $5. The P/E ratio would be P/E ratio equals frac text price text EPS equals frac 50 5 equals 10. Find the expected growth rate. Let's say the company's earnings are expected to grow by 15% annually. Express this as a whole number for calculation. Growth rate equals 15%. Calculate the PEG ratio. Divide the P/E ratio by the growth rate. PEG ratio equals frac text P/E ratio text growth rate equals frac 10 15 equals 0.67. This result, a PEG ratio of 0.67, suggests the stock may be undervalued considering its growth potential. In general, a PEG ratio of less than 1 is seen as favorable, indicating that the stock's price doesn't fully reflect expected earnings growth. Using financial reports. Locating accurate data for calculating the PEG ratio requires a careful dive into a company's financial reports. Here's how you can proceed. Price and earnings data. Income statement. Look for the EPS to understand the company's earnings. It's typically located near the bottom of the income statement. Market reports. Obtain the current stock price from financial news websites or trading platforms. Growth rate. Management guidance. Company reports often include management's expectations for future growth. Check announcements or presentations. Analyst projections. Financial analysts' reports can forecast growth rates. These might be available through investment news services or brokerage platforms. You don't have a crystal ball, but with these reports, you're pretty close to having one. Keep in mind, the quality of your input data directly impacts your investment judgment. Calculating the PEG ratio with precision will empower you to make more informed, strategic investment choices. Analyzing PEG ratio values. Grasping the nuances of the PEG ratio is crucial for investors seeking to make informed decisions about stock valuation. This section breaks down the implications of low and high PEG ratios, helping you interpret how they can align with your investment strategy. Interpreting low PEG ratios. What does a low PEG indicate about a stock's potential? A low PEG ratio often rings a bell for investors as a sign of opportunity. When a stock showcases a low PEG, it indicates that the price is not steep when balanced with its growth potential. This can be particularly exciting for those on the lookout for under-the-radar opportunities. Here's what a low PEG can signal. Undervalued gems. A PEG ratio below 1 suggests the market might have underestimated a stock's growth prospects. This can be a strong signal to dig deeper, as such stocks might offer substantial upside potential. Growth potential. Imagine a train poised to accelerate but still waiting for the green signal. A low PEG ratio hints at growth that's yet to be fully factored into the stock's current price. Risk assessment. Of course, a low PEG doesn't guarantee success. It's essential to consider broader market conditions and company-specific risks. What external factors might influence the undervaluation, for instance? Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.